Differentiating types of bonds from low risk to high risk. There are numerous ways to differentiate between bonds, with the most significant means to differentiate bonds being based on their relative level of risk versus return, with less risk resulting in lower returns, while heightened risk requiring higher returns to entice investment in riskier bonds. This in turn is dictated by the issuer of the bond and what assurances the issuer is able to provide, such as you're typically moving from a government bond issuer with less risk and lower returns to a range of corporate bond issuers, where their heightened risk level generally necessitates ever greater returns being offered by those bond issuers to generate interest in their offering. T-bills, commercial paper, and bankers' acceptances. Treasury bills, T-bills, and other money market securities such as commercial paper and bankers' acceptances are considered to be the safest segment of the fixed income market. Issued at a discount, T-bills are short-term debt securities issued or guaranteed by federal, provincial, state, or other governments. The stated interest rates for T-bills are fixed when issued, but values fluctuate based on changes to the central bank rate. A T-bill's return is calculated based on the difference between the price paid and the par value, also known as the denomination or face value. T-bills mature at par, typically 90 or 180 days, and do not pay fixed interest payments like most bonds. Unlike T-bills, commercial paper and bankers' acceptances are issued by corporations. A commercial paper is a negotiable promissory note with a term of a few days to a year and is not generally secured by company assets. A banker's acceptance is a short-term promissory note bearing the unconditional guarantee acceptance of a major chartered bank. Bankers' acceptances offer superior yields to T-bills with higher yields and liquidity than most commercial paper issues. Government bonds. Issued with terms of maturity between 2 and 30 years, government bonds are considered very low-risk fixed income investments as they are backed by governments. The value of government bonds fluctuates based on supply and demand in the market. A government will increase the supply of bonds to raise money, which will be used to stimulate the economy. Demand for government bonds tends to increase during periods of low confidence in equity markets as investors seek safety. Demand also tends to increase in periods of weak economic activity when the threat of inflation is minimized. Investment-grade corporate bonds. Issued by large corporations, these corporate bonds are often called investment-grade because they are issued by very credit-worthy companies with high credit ratings. Standard & Poor's assigns credit ratings of AAA, AA, A, or BBB to investment-grade bonds. Investment-grade corporate bonds offer a slightly higher stream of income than government bonds because they are not guaranteed by a government. The difference in rates, interest rate spread between corporate and government bonds generally rises and falls as a result of investor confidence, investors' willingness to take risks, the outlook for the economy, and growth in corporate profits. Interest rate spread, or simply spread, is used to describe the difference in rates between the different types of bonds. With investment-grade corporate bonds, investors assume the risk that the issuing company might not be able to make its interest and principal payments. The risk of investment-grade corporate bonds, however, tends to be very low. High-yield corporate bonds. High-yield corporate bonds are sold by corporations that do not have the same high credit rating as investment-grade issuers. Standard & Poor's assigns credit ratings of BB or lower to high-yield bonds. Historically, high-yield bonds have provided investors with a higher yield than investment-grade corporate or government bonds. This higher yield helps to compensate investors for the risk of the issuing company not making its interest and principal payments. Due to their higher risk of default, the interest rate spread between high-yield bonds and government bonds is wider than the spread between investment-grade corporate bonds and government bonds. Emerging market bonds. Emerging market bonds are issued by governments or companies in developing countries. Emerging market bonds typically pay higher yields than investment-grade bonds in both the United States and Canada. This extra yield pays investors for the added risk of investing in countries with shorter records of sound economic policies and less established institutional and governmental frameworks. In recent years, many emerging market countries have adopted conservative banking and regulatory regimes, have reduced the risk and increased the credit quality of their bonds. Convertible bonds. A convertible bond is a fixed income security that gives the holder the option to exchange for a fixed number of shares at any time. As a hybrid security, convertibles have debt and equity features that provide investors with the downside protection of bonds and upside potential of equities, while exhibiting lower interest rate sensitivity than traditional fixed income securities. For more business and financial insights and information, subscribe to our channel and learn more about our business through our website. Thank you.